Right, good afternoon, everybody. As you can see, that was me when I was a lot younger. Why would you put a photo on me now? Can House Finance Limited. I'm based in the High Street in Evesham. Okay, so I've been working out of that office since 2014. I love what I do. So the title of the talk is Don't Believe the Man in the Pub, because the man in the pub will tell you, oh, equity release, oh, you don't want to be doing that. And that was kind of what it was a few years ago. It was unregulated. It could be sold pretty much by anybody. And the lenders, well, they were they were a gang of swines, really, because they were selling things whereby you had a mortgage on your property, they gave you the money, but in return, they wanted a lot more back than just the money and the interest and all that sort of thing. They wanted to have a share in the appreciation of the value of your property as well. So those days have gone. This is a heavily regulated industry. I have to do a lot of groundwork with my clients to make sure that they understand what they're doing, that it's not going to affect things in the future for them. So say, for instance, I have somebody coming in and they're on benefits. You know, I can't say to them, oh, do equity release, and then they have a lump sum of money land in their bank account and then they don't get their benefits, because it can make a hell of a lot of difference for them. So we do things like that. And we also make sure that there's nothing that they could be applying for or receiving in a benefit that they may be missing out on. So that's all part of it. So the man in the pub is a little bit ill-informed. If you say stuff like that, you don't really understand it. And unfortunately, there's a few solicitors that say things like that these days as well. And it just shows a little bit of that then they don't really know. So on to the next. So what is equity release? So equity release is basically, it's a mortgage. So most people in their life have had a mortgage, okay? So the house is still yours. It's just got a mortgage secured on it, okay? A lot of people think that equity release is, oh, you're giving your house to somebody else. You're not. In this case, what I'm talking about is a lifetime mortgage. So the difference between this and a normal mortgage is it's basically designed to last your lifetime. It's not a 2 or 3 year thing, or with a longer term, and you might be with a lender for a couple of years and you might go to a different lender, that sort of thing. This is long term. So you are tied in for a longer period of time. Now, we live in a world whereby up to the age of 55, because you have to be 55 and above to qualify for equity release, up to that age, you want a mortgage. It's about how much you earn, how much you spend, how much have you borrowed, all that sort of thing. Can you afford to pay that mortgage back? That's how they look at it on a normal mortgage. Equity release is totally different. We turn it around. It's about the house. Is the house adequate security for the loan? So basically, if you come to me and say, I might be interested in equity release, we'll have a nice cup of tea and we have a good old chinwag about your situation and what you want to do. And we talk about, your house and whether or not that's going to be a lender will lend on it, that sort of thing. So it's a total turnaround. So it gives people an option, and especially sometimes people who run, their own business and stuff, where your income can be a bit sporadic. Your lifestyle has been it's a little bit different, and you don't fit in a box, which normal mortgages want to, fit you into. The equity release might be a solution to something. Okay, so equity release available to homeowners 55 and above. You can receive your cash as a lump sum or as an income, or both. So you can have a lump sum of money and you can set up a reserve account, and you can pick the phone up when you need some money and say, oh, can I have some money out of my reserve account, please? And they put it in your bank account. So, in a situation, if you've only got a pension or something, you might be supplementing your income with it because of the cost of living, or you might be going, oh God, the boiler's broken down. Where am I going to get £5,000 for a boiler? Pick up the phone and ask for some money. The cash is tax-free, because if you sold your property and you put all the money in a bank account, you wouldn't be paying tax on that. You pay interest on what you've got in the bank, but you wouldn't pay tax on it because it's your main residence. Okay? Not based on your affordability. So again, not on your income. Not on your income at all. So you don't need to make monthly payments unless you want to. So we've got more and more flexibility in the products. You can use it like an interest-only mortgage if you want to. You can make monthly payments if you want to. You can make a monthly payment 1 month and then not for a couple of months. Nobody's going to come and say, why haven't you paid? You did last month. Why haven't you paid this month? Nobody's going to say that. It's a voluntary payment. And throughout the borrowing process, you continue to own your own home. So you borrow a proportion of your home's value. So the amount you can borrow is based on your age. The older you are, the more you can borrow, okay? The interest is charged on the amount throughout your lifetime, okay? So that is a fixed rate of interest. So if someone says to me, Karen, I want to borrow £10,000, I'll say, and this is how much my house is worth, I can do some an illustration form that shows them to the penny how much they will owe at the end of every year. So there's no nasty surprises on that because we know what the interest rate is. It's fixed for the whole term of the loan, and so we can tell them exactly how much they owe. So, and then they've got the option to make payments, which of course would reduce how much they owe if they want to. Okay, continue to own and live in your own home, and you don't have to repay the loan until you die or go into long-term care. So that's the end of the mortgage. If you're no longer living in the house and you've died or gone into long-term care, that's at the point at which the mortgage ends. If there's two of you, it's the point of which that the second person dies or goes into long-term care. Okay, so it is a long-term commitment. So you've got to, that's why the advice process is so important, that we discuss everything and make sure that people have thought everything through. With a drawdown lifetime mortgage, take smaller sums over a period of time. They're always at a fixed rate of interest, but the interest rate can be different depending on what's happening in the outside world, because we know about interest rates, they do all sorts of weird things. So it could be that the client takes an initial amount and it might be, I don't know, 5.5% or 6% of interest, but then they might pick a phone up, want £5,000. It might be a lower interest rate, might be 5%, might be 4.5%, or it might be 7%, depending. But they've got a choice whether or not they go ahead when they know what the interest rate is. It's similar to a normal mortgage, like I said. Lender takes a charge on your property. It's a similar legal process. I'm a member of the Equity Release Council and are all of the lenders that I use. And then what that is we've all signed up to try and make equity release safer for people to do, and also promote how safe it is in the right circumstances. It's not right for everybody. I have quite a lot of people, quite a few clients come in, and when I've heard about their situation or whatever, I might say, it's not suitable for you. I don't think you should be doing this. You need to take my advice and not think that it might be something that changes in the future. They walk in and they've got lots of savings. For instance, I had a client at Broadway, lived in a £1 million house, £300,000 in savings, looking at doing equity release. Why? And they're in their 80s. Go out and spend it. Do that first. This is supposed to be a last resort. Equity release is a last resort, unless, which is what we've been talking about today, is part of a plan of your finances. So for instance, take some money out of your house, gift it to your children. If you last long enough outside the 7-year window, it will be outside of your estate. So you've managed to gift that tax-free. There's lots of things you've got to think about in those circumstances, but it's something that financial advisors are starting to think about as part of the whole process and rounded approach to clients' finances. So the amount you can borrow, like I said, depends on your age. The older you are, the more you can borrow. If you've got health issues, you may be able to borrow a bit more, because it's all based on statistics. No requirement, like we said, to make any payments. Okay, and that's a little bit about the Equity Release Council. There's a no negative equity guarantee. So bearing in mind, if the loan is rolling up and getting bigger, if it got to the point whereby the house is worth less than the loan, it's not the client's problem. Okay, the lender takes that risk on. They do all the stats. They're, banking on the fact that your house is worth more than the loan, and they're going to get what they're owed back. If that does go wrong, then it doesn't affect you. You wouldn't be leaving any equity in the property for your children, but nor would you be leaving them a debt. So it's something that gives you a bit more peace of mind. You can move house. You have the right to move your mortgage to another property, which we call porting. So you're not as stuck. When these products, a few years ago, they were more restrictive. There's a lot more get out of jail cards with them in inbuilt in them. For instance, if one of them in a couple dies, there's usually a 3-year window. You can sell the property, move in with the kids, annoy them, pay the mortgage back, and you won't get penalised for it. Okay, so how can we or I help specialise in equity release? I love equity release. Reason I like it so much is my clients are, I don't know, they've had more experience of life, they've maybe got to live more time. I spend quite a lot of time with my clients, basically as much as they want or need in order to feel happy with what they're doing. I'll go and see them in their own home if it's difficult for them to travel. There's no upfront charges. Any costs involved in equity release can come out of the lump sum that they're raising if that's what they want to do. I'm independent. Like I said, it's heavily regulated. There's lots of things we talk about as part of the advice process to make sure that it is the right thing and that they've thought through all the consequences. We were talking earlier about people who'd put a property into trust and it's caused a hell of a lot of problems later on in that they can't do anything with the property in the future because none of us know what's around the corner. So we have to, you know, with clients, talk about it. What happens if one of you dies? Would you be able to afford long-term care? Where's that money potentially going to come from? All those sort of questions, which are sometimes a little bit uncomfortable, but we have a nice chat, make people feel comfortable and have a chat with them about it. And in summary, equity release, complex legal arrangement. Expert independent legal advice will always be involved within the process. So part of the process is that you do need legal people. They have to do the securing of the charge on the property, etc. And as part of that, they double check what I've done, and what they're doing then is they're making sure that the person who's doing it understands what they're doing, the consequences of what they're doing, and that's an equity release counsel requirement for independent legal advice. So we'll talk you through options, advise you on how much you can borrow, establish if it's right for you, like I said, and answer any questions that anybody has at any time. So if anybody knows anybody who, for instance, has an interest-only mortgage and thinks, oh gosh, I've got to sell my house because I've got to the end of term, lenders are getting very aggressive about interest-only mortgages. I had a client, we did one end of last year, just before Christmas, and they'd been into court once, they were threatened with repossession. We were able to flip it into an equity release product, so they are now secure in their property. You know, anybody who just wants to have a bit of a chat about anything like that, just to see whether or not it might be right or whatever, happy to have a chat, cup of tea, whatever. All right, so that's equity release. Has anybody got any questions?
Can I add something? So we as GEM financial advisors, 5 of us that do mortgages, which I know 3 of us do anyway. And we took that decision because I think one of the questions that the man of the pub would surely have an answer for. If you've got equity release and you need to go into care, do they take the care?
Well, I think, you've already, if it depends on the situation as to whether or not there's somebody else living in the property and whether you're the first person, but basically you've reduced your money that you've got for care, which you've got to be aware of as well. But you are paying, you've used it up, so therefore it's gone, isn't it? It's gone. We have a long chat about care and things with clients to see how they feel about it. A lot of people are very much of the opinion that, you know, I've said I've never had a client who says I want to go into care. With the reserve account, you could, instead of going into care, pay for your own care in your home. So you've got more options with that about care. And of course, if you are paying for your care up front, you've got some control about where you're going. Whether or not whether or not the funding kicks in later depends on your individual circumstances. But yes, you're reducing what you've got, so therefore paying for your own care is potentially less likely. But there's lots of things that happen with that as well.
I know one of the issues with the last and equity release, there would still be a big chunk of money there.
Yeah.
So I'm assuming the house would just get sold.
Yes.
And the debt be paid off.
Debt paid off, yeah. Yeah. So basically the mortgage ends at the point of either death when you permanently leave the property. If you're still alive, then you can be in control of, of that, or your people who are helping you out, etc. If you've died, then it's over to your executors, but the lenders are only entitled to the mortgage the amount of money you've borrowed, and any accumulated interest. They're not entitled to anything else. And if somebody's inheriting that property, because the will says that's where it's going, that person, if they pay the mortgage off, then that's absolutely fine. Nobody's going to make them sell it in those sort of circumstances. Mm-hmm. Yeah. In value. Yeah, so the issue, and I always say this to clients, that you can port it, that what is obviously got to stack up on the figures. So it depends on what you've borrowed, how much it's rolled up, and how much you can borrow on the house that you're moving to. So how they view it is the house you're moving to, how much would they lend you on that house? Were you approaching them as a new client? Yeah, so in that circumstance, if you've borrowed a lot of money and it's rolled up over a long term, it's unlikely it could stop you moving. If it's a small amount and it's not rolled up as significant, it might be that you can still do it and add on and borrow some more. So it depends. It really depends on your individual circumstances, I'm afraid. Yeah, but I do warn people. It's got 2 questions. Go on then.
Just a quick testimonial. Thank you for helping me.
Thank you very much, Peter. Good. Thank you very much for that. Appreciate that.
Just a quick question though. My brother asked me about equity. What I said to him was to manage expectations.
Yes, you do. And that's,
would you say that's important?
Very important. It's one of the part of the advice process is we want to know who are the beneficiaries of your will. Are you going to discuss this with your children or your beneficiaries, whoever they may be? Because of course, if they're not aware that there's equity release on a property and they think, when anything happens to mum and dad, I'll be all right. You've got to, like we said, manage their expectations. As an advisor, this is quite a high risk business to be in. That's one of the reasons the Equity Release Council is very helpful, gives us support, and we have the legal process backing us up as well. But it's very, very in depth. It's the biggest risk comes from the children saying, Mum and Dad wouldn't have done this. They would not have done equity release on their property had they realised what it was, and you've sold it them. So you are responsible. You haven't advised them correctly. So we have to make very, very sure that we have advised them correctly, and also that we can prove that we've advised them correctly. So yes, we do. We talk about the kids, all the beneficiaries, who's in the will, that sort of thing. We also talk about power of attorney and how important that is. As part of the process, as anybody who's been unfortunate to have anybody in a situation where they've lost any sort of capacity and they've had to go via the court of protection and the costs involved in doing that, everybody wishes they'd sorted out a power of attorney prior to that. So it's something all of us should have, guilty as charged. I haven't got one, but we potentially all should have one. But yes, thank you. I know, yes. Is the plumber's dripping tap.
Once you reach the age of 18, you are an adult. You're an 18-year-old.
Yeah.
So once you turn 18, power of attorney is.
Well, yeah, it's the head injury thing, isn't it? If you're in, I mean, I had a client who she was over here. Daughter-in-law was in Australia trying to help her. She had 24/7 care in her home, and the daughter-in-law was paying for it all. And she said, we've got to get equity release because I've got to have my money back. I can't keep doing this. So we looked into it, and unfortunately, the power of attorney didn't let them borrow money. They'd done it, but they didn't let them borrow money on the house. So it had to go back to the court of protection. By the time they'd actually got a response, the lady had died anyway, because it took a good sort of 12 months. So it's very, very frustrating. So we advise people about things like that, doing that at the same time. It's because if you're in the situation, if you had the drawdown, a reserve, where you have an initial lump sum and then a reserve account or a facility available to you, and your partner has dementia or something, you've got money there to pay for care. You can, for as long as possible, they could potentially stay at home with you and that the care in a care home is the last sort of resort. So it gives people a lot more power in what they're doing, because if I see pension incomes, it's very rare. A lot of people, small private pensions doesn't really do a lot. Government pension, it's not great. Cost of living's going up. A lot of people are struggling, and this can make a difference between having one bar on the electric fire and having a nice retirement, a nice, comfortable and warm retirement. That's all right.
A reason that the minimum age limit is 55?
Yes, basically, it's all down to statistics. Yeah. So basically, I'm 55 this year, so I'm like, I could do equity release, but I'm going to take my money out of pension instead. But never mind, that's not great financial advice, really, is it? But I don't advise on pensions that take no notice. But basically, if I could statistically probably live to my 90s or 100 years old, couldn't I? If I took it out at 55 at a fixed rate of interest, so say, for instance, it was like, I don't know, a quite high interest rate, the debt would double in sort of a 12-year period. So we're hoping that the house values will go up anyway, and reduce some of that impact on the property value, but it doesn't always happen. So if you imagine that happening and that doubling, that debt doubling, because I'm not making any payments on it, I live to 100, it's a bit more risky. And of course, they've got their money tied up for quite a long time anyway. So you move that forward to like 45, you're adding another 10 years on. It doesn't really work. We have to be especially careful if we have clients in their 50s as to the advice that we're giving them, because it's quite different. Because for that reason. Yeah.
They'll only allow you a percentage of your house, and of course, the older you are, the bigger the house.
Yeah. They don't tend to lose out, do they?
They'll never be the loser.
They'll never be the losers. Any other questions at all? No? Okay. All right. Very much.